You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, and welcome to the Infinite Banking Mastery Podcast. Thank you for listening in today. On this episode, I wanted to talk about how banks make money. Do they make all their money by investing in the stock market? I think a lot of people think that that's a big part of what banks do to earn their money, but that's not it. Actually, the primary way that banks make their money is by loaning out our money. They take our money that we have with them in savings accounts, they wrap it up with interest, and then they sell it back to us. So interest income is really the main way that banks are bringing in their cash, their wealth, they're growing their wealth. That is how they earn the big bucks. So now if we go back in the day, back to the 17th century in Europe, in London, this is where banking really first started, like the idea of banking first came about. Banks actually started out as goldsmiths that had a lot of vault space and were trusted. They already were protecting their own gold. And so they were trusted. They had these sturdy vaults to store, these big warehouses. And so customers trusted those locations. And then they started offering their vaults to their customers for a fee to store their own gold coins in these vaults. And so once the customer left their gold coins in the vault, in exchange, the goldsmith would give them a paper receipt, a bill of exchange. So these paper receipts became very important. You don't want to lose your paper receipt. And initially, only the person, the owner, could come in and redeem these receipts for their gold coins. But eventually, they were able to endorse these receipts to a third party. So enter checks. That became the first checks that were out there. So these goldsmiths soon realized, hey, we have all these gold coins building up more and more. And, there's already people out there who are lending coins. Why don't we lend coins? We already have a stockpile of coins and it's just getting bigger. So maybe we should become lenders as well. Except for they were lending other people's coins. So they decided we have all these coins, we can lend them out, but they're not lending out their own coins, they're lending out other people's coins. Because they realized that very few people came in at the same time to request their coins back. And actually not more than 10 to 15% ever really was missing at one time from that stockpile. So since withdrawals were less than 10 to 15% on a regular basis, they decided, well, we can lend 80% of these coins or maybe even 85% of these stored coins. And so that is how banking was born. These goldsmiths started to act as loan brokers on behalf of the customers who were storing their gold in their warehouses. Although initially, customers didn't know their coins were being lent out, actually. It wasn't until after they found out, got mad, and then finally these goldsmiths started to share this interest income. Now, this information that I'm sharing, it can be found in different books. The book that I'm referring to, that I'm taking the information from, is called The Creature of Jekyll Island, A Second Look at the Federal Reserve, and it's by G. Edward Griffin. Now, you might think a book about the Federal Reserve would be horrible, maybe dry, boring. No, none of the above. It is a fat book, about 600 pages, but it is an interesting book. Actually, I was really surprised when I started reading it because it started off like a story and it was really captivating. And I thought, oh, wow, because it starts off with the story of how the Federal Reserve began. And so you might think that's a boring read, but I'm telling you, it's actually interesting. Now, let's fast forward to what today's banks look like. You can draw out or just picture 3 circles. You might want to grab a paper and pen or else just kind of stick with me here. If you draw out or envision 3 circles, the first one on the left says saver inside or below. The one on the right says borrower, and the one in the center says bank. So what's happening is all of us people, we are doing both of these actions. We are saving and we are borrowing for things that we need. Most people are doing this anyway, probably not all people. Most people are trying to save for something big, retirement, maybe college for their kids, saving up, maybe a down payment for their house. And they're also trying to buy something right now. So we need to go out and borrow for a new mortgage, borrow for a new car or a new boat or something. So we're out there, we're needing to borrow and we're needing to save at the same time. And so banks understand that every time money moves, there is a profit to be made. So they've centered themselves in the middle of this activity. Now, I have some information here. It's from a bank analytical report called the Bauer Financial, which you can acquire yourself. You can go online and find this information. And I'm going to be talking about Bank of America. This report does cost money if you wanted to acquire it. So I'm going to be referring to numbers from 2017. So in 2017, Bank of America had $909 billion on deposit. That's total deposits, checking and savings, people depositing into the Bank of America. And of those deposits, the people who had money in savings accounts, Bank of America paid them interest to have their money at their bank in savings accounts. And Bank of America paid those savers $3.1 billion. So the savers made $3.1 billion. And borrowers who went to Bank of America and wanted to borrow some of this $909 billion, well, of course, they had to apply. They had to be working. You can't just go there with no job. They're going to kick you out. They also wanted to check your FICO score, your credit score. That was important. You might have to pay some fees. So these borrowers who went in maybe had to go through all these hoops and fill out all this paperwork to try to get a loan. Once they did, they paid Bank of America $49.9 billion in interest to borrow some of that $909 billion. So we paid Bank of America $49.9 billion, and Bank of America paid us, the savers, $3.1 billion. And so they did 16 times better than us. That's a 1,600% spread. And just so you know, the interest rates that I am referring to in this example, the savers were being paid 0.34% or 34 basis points. And the borrower was paying the Bank of America 5.5%. Now, as a side note, had you gone to your whole life policy to borrow funds for any of these needs that you had, you wouldn't have to have jumped through any of those hoops. You wouldn't have to fill out an application, or they're not going to check your job status or your FICO score or anything like that. When you ask for a loan against your life insurance policy, boom, you get the money right away. Now, if you drew out these 3 circles, or if you can envision again these 3 circles and add the word family in the center circle so that now it says family bank, this is what we're trying to teach our clients, how to create their own family banking system so that they can start recapturing some of the interest that is otherwise going to banks. You want to be the one capturing interest with the velocity of your own money. Stop giving up the interest that you could have earned to banks instead. Instead, create your own banking system to start retaining that wealth. And by having your own banking system, you also get the control that comes with that system. So when you have a life insurance policy and it has built up cash inside and you want to borrow against it, you have full control. You can choose what you want your payment to be. You can pay interest only for a period of time. You can pay it all the way off and you're not going to have a penalty. You can create your own payment that you want to pay yourself back. And we can help you to create an amortization schedule to actually pick how long you want to take to pay the loan back, or how much you want to pay back, or what interest rate you want to pay yourself back. Now, Nelson Nash would always say to pay yourself back with interest and at an interest rate greater than what the insurance company would charge you. So that would be the best way to do it. But the good thing to note is that you are in control and you can do anything that you need to in that time. Or if there's a hardship, maybe a job loss or something, you could even take a year plus off, take a couple years off and pay yourself nothing back for a period of time if you're enduring a hardship. Now, again, that's not what I would recommend for you to do, but it is a possibility. And now, how many places can you go, request a loan, and then choose when to pay it back and not pay anything back? I mean, nobody. You can't do that anywhere. It's not possible. Now, this description that I just went over about how banks make money, it doesn't even get into the details of fractional reserve banking. Now, that's a whole other mountain of crazy. And we will get into that topic, lucky you, of fractional reserve banking next time. It's an interesting topic. It amazed me when I first heard it. It blew my mind. I was like, what's going on? I think you're going to enjoy it. Until then, please reach out if you would like to connect, to chat about how the infinite banking concept could work for you or your family, how you could start your own banking system that you can be in control of, and to start redirecting that interest to yourself. You can reach me at Valerie@alphaomegawealth.com. I do hope this information was enlightening, and I hope you'll listen in next time. Have a great week.
This is thepodcastfactory.com.